Hello everyone and welcome back to a new weekly market review by ATFX. My name is Gonzalo Canete and the goal of this video is keep you completely updated about macro data and also financial markets. We're going to make a review on the last macro data published this week, the last week of August, 1st of September. Today, Friday, by the time I'm recording this video, 2 p.m. UK time, London, we're going to actually review the fresh and recent data related with labor market in US, unemployment rates, and also non-farm payrolls. We're going to make an interpretation and review on that data and see what's the reaction of the market. I took a few notes just to give you a fresh and quick update on the last macroeconomic data published this week. We got data from Europe, we got data from US, we also got data from China. But I want to give you just the highlights. In this case, in relation with Europe, let's start with Europe. This week it was really interesting because we got inflation rates in Europe. We also got industrial manufacturing index for Europe. We also got that numbers specifically important. It's for Germany because Germany is the first economy in Europe and is the one who is facing now a clear recession. Actually, I'm gonna share with you by the end of this video one article I found on Daily Mail, British press. They mentioned how UK economy is overpassing the German economy in terms of growth rate. Even in terms of inflation, UK inflation was the worst in the whole euro area, but is getting really close to German inflation right now. We're gonna review all those numbers to just prove this point from the Daily Mail. Let me share on the screen with you the article, right? This article, it's just super pride, it's British press, but super pride to show you how the UK economy, paradoxically, right, it's rising and growing faster than German economy after Brexit. Remember, during the Brexit votation, most of the institutions, international institutions, European Union, even the whole UK government by the Prime Minister of UK, David Cameron, the man who proposed the referendum related with Brexit, was the one who was saying, if you vote for Brexit, we're going to go to a global recession, UK going to lose millions of jobs, blah, blah, blah. We can see the prophecy never was complete. And now, surprisingly, UK economy is growing faster than German economy. But let's come back to the calendar. Let's come back to the numbers first. So inflation, first of all, European inflation is at 5.3, exactly the same like it was on July. So August, 5.3% on inflation rate. It means like inflation is getting flat in Europe, unfortunately, because the expectations, the main goal was get inflation under control, get the inflation reducing over the time, just to be sure that at least monetary policies in Europe, Central Bank of Europe will get some mercy, will show some mercy in terms of cut the interest rates rising, right? But it didn't happen. We also got from the size of Germany. Well, the unemployment rate in Europe is 6.4% in the last numbers from July updated. Germany is rising in terms of unemployment rate, is rising to 5.7%. Bad news for Germany. Unemployment is rising, the first economy of Europe. Yeah, retail sales are dropping to 2.2%. Inflation drops to 6.1%, but it's still 6.1% of inflation in Germany. Considering that Germany got 3 periods already with no growth. Remember, we started first quarter 2023 with a drop on 0.2, 0.8% on German economy, which means clearly like after 3 periods with no growth is recession. Now, this is one of the most important lectures or readings that you can take from this last week of August. Bad macro data on Europe, which is mean like Germany is growing really slow. Right now, the annual projection of the growth of Germany for 2023 is minus 0.20%. But the problem is they got an inflation of 6.10%. That means a concept that Central Bank of Europe is starting to talk about, which is stagflation. Stagflation means no growth, no economical growth, plus inflation. One of the worst scenarios that we can face in an economy. What else? We also got economic sentiment dropping in Germany. Consumer confidence is dropping also. Business confidence is dropping in Germany. As you can see, all macroeconomical parameters that we can check are clearly giving bad signals in Germany. We also got a weak PMI prices manufacturing index is showing contraction. All of the prices manufacturing index from Europe are below 50. I will show you here. The only one that is improving is China in these parameters. But if you take a look on any calendar you can find online, I'm just using the investing.com calendar. But if you check any other ones, you will find out that actually all these parameters related with price manufacturing index is showing contraction. Below 50, remember, below 50% is contraction, above 50% means expansion. And as you can see, we got Italy here, 45.4%, 46% for France, 39.1% for Germany, 43.5% for Europe in general. So definitely not the best numbers you expect to see. Surprisingly, and good news is that China is 51%. On this price manufacturing index, which is proving that China is recovering from 49.2%. This is one of the main fears of the market right now: deceleration, a recession in China, because it's the second biggest economy in the world. We mentioned, I believe, in previous reports that, for example, South Korea exportations are dropping for 10 months already in row. Investing flows in Japan are dropping massively. You can read here like they were expecting the previous period, the Q1 of this year, the investment ratio in Japan, it was 11% and it's dropping to 4.5%. So macro data, globally speaking, is not good. Still, US is resisting really well. You got here the non-farm payrolls published like 30 minutes ago. It's showing us that it's 187,000 new non-farm payrolls requested versus 170,000 expected. This lecture should be like, well, I can see by these numbers that the labor market is getting weaker, but the problem is everything below 200,000, it means like the economy is not that weak. And actually, if you check the unemployment rate, it's where we got it. Let me check unemployment rate. It's here, 3.8%. The expectation was 3.5%. It's 3.8%. It means like unemployment rate that rises in the United States. Labor market is getting weaker, and therefore, Federal Reserve gonna get certain mercy and start to give to Wall Street more oxygen, more flexibility in the interest rate. That's not true. That's not the case. In my opinion, in my reading, everything below 4% unemployment rate is super good. Still, yeah, we're rising from 3.5 to 3.8. Yeah, not bad enough. Not bad enough to reduce, to get the Federal Reserve policies colder. It's not good enough. I think that's not enough, and we will see now in the charts. We're gonna take a look to the market. We're gonna review the charts now. We're gonna go to Standard & Poor's to review what's the reaction of the price in the U.S. market in the main and biggest index. But believe me, in my reading, the equity is right now in a very, very difficult moment, not only for US, but especially particularly for Europe, okay? What else I need to mention to you before we switch to a new different topic? We also knew this week the Central Bank Europe notes. They are considering to eventually keep increasing 25 basic points interest rate on September, this entry month. But the problem is that for the first time they are talking about stagflation, like the inflation plus recession, which is the worst scenario. And right now they need to start to consider that. Remember, I think we also mentioned the previous report that from those 6 top economies in European Union, 3 of them are in recession right now, and 2 of them are really big. We're talking about the German top 1 economy is in recession officially, also Netherlands. We also got Poland decreasing the industrial activity. So the rest 3 countries there are France, are Italy, and are Spain. And if you follow more or less the evolution of these countries in Europe, you will find out that actually the weakest point of France is the fiscal control. The deficit they got is massive. The weakest point for Italian economy is the financial sector, the banks. And the weakest point for Spanish economy is a super high unemployment rate for the last 10 years. So these 3 economies are actually not the best and strongest economies in Europe, and are the ones who are right now not presenting or showing any signals of recession. So in my eyes, unfortunately, probably these three economies are not the best ones to resist this move. They cannot pull out of this recession European Union by themselves. So that means like sadly we're probably going to face a recession imminent in the whole European Union, which take me to another comment they did. The Central Bank of Europe basically mentioned that so far, if there is no a total recession in the European area, the Central Bank of Europe gonna keep their monetary policies, which means they're gonna keep rising interest rates. And if you take a look also by trade economics, if we review the numbers, they got it. Still, the inflation rate by average is 5.3% in European area, and the interest rate is 4.25%. That means like interest rates minus inflation, real interest rates are negative in European area, and therefore monetary policies follow the book, follow the rules, follow the guidance. They need to keep increasing interest rates until they overlap the inflation rate, just to make the money got a positive value. Otherwise, in European Union, under these conditions, money is losing value every day. They know that. It's just the basic book rules for economic policies. They know they have to take certain actions. It's very interesting also mentioned that one of the more inflation factors, apart of the energy, obviously, is the grain. We know, because we were analyzing, even reviewing the BlackRock report, that inflation was dropping because two main factors. Energy was dropping massively. In that, let's say the components of the inflation, two of those components, it was energy and food. And both of them was the ones who were dropping massively. Services prices was more or less stable, which means like inflation had get reduced by the reduction of the prices on energy and reduction of prices on food. And when we talk about food, we talk about bread. We talk about grain. The main exporter and producer of grain is Russia, followed by Ukraine. Now Russia is controlling the exportation routes of Ukraine, which means like they blocking the maritime traffic and trade on Black Sea. Now, this is important because United Nations have sent an offer to Russia to retake the negotiations over the Black Sea grain deal. Just to refresh you and to keep you updated, remember, this negotiation was broken on July 2022. It was they broke the deal. The negotiation would fail basically because Russia was saying that European Union was not in complaint with the agreement, which it was include Rosneft Bank, the agricultural bank of Russia, in the SWIFT system to receive the payments in exchange of the grain. So basically, Russia was saying, if you don't integrate Rosneft Bank, our agricultural bank, on SWIFT system, we have no guarantees that you're gonna pay back our grain, and therefore there is no deal if you don't integrate back again Rosneft Bank on the SWIFT system in Europe. It didn't happen. Now United Nations is trying again. Keep an eye on this because on Monday there is a meeting between Erdogan, Turkey, and Russia, just to see if they can find again a new agreement to reactivate the trade on the waters of the Black Sea. Yeah, so that's very important. Yeah, and mainly I think this is a good review of all macro data. We got it. We also got the GDP of US published this week. It was 2.1% versus 2.4%. Still, let me say this, right? 2.1% of growth rate in US compared with the growth rate of Europe, which is 0.6% right now. It's super good. And even if they want to make the situation more flexible and more soft in America, in US mainly, they're gonna find really challenging to get the dollar weak and cold and cheap again if more of the investment flows are going from Europe to US. If, let's say, we are foreign investors, we are hedge funds, we are investing in banking industry, and we're looking for where to allocate our assets, our liquidity, we're probably going to prefer to allocate that assets in US, where, by the way, the 10 years bond is quoting about 4% of returns, compared with 2.5 of German bonds and 0.65 of Japanese bonds. So it means like the whole capital, all money is flowing, all risk is flowing to American markets in these situations. So I think it's gonna get overheat the American economy really soon, and unfortunately, this is in line with the recession in European Union. Yeah, don't forget, before I switch to the charts and we take a review on the market in terms of prices and opportunities, don't forget to read this article. Germany is heading into a recession caused by its green energy policies. Its politicians warn as the country is labeled as a sick man of Europe for its stagnating economy, while Brexit Britain sees growth. It's a good comparison, but mainly and basically it's a review of what's the voices inside of Germany related with the policies the government is taking right now. We have heard CEOs from top companies. We also know that different parties from the opposition, starting with the AFD, the Alternative for Germany of party, was trying even to get illegalized because it's rising a lot on the pools apparently, and they are super criticism with the government right now. But now the main opposition party is saying that they are wrong. Even they were proposing in this article. You will see all the details, right? Because it's a long and extensive article about this topic. But you will see that even the main party of the opposition in Germany is suggesting that if they win the elections and they become the government in Germany, they're gonna reactivate immediately nuclear centrals, nuclear energy stations. They also gonna stop the green policies and reduce the taxes. Okay, take a look because this is very controversial and it is here. Mail online. You got the Daily Mail with this article, always controversial, but super proud mainly about this: the overpass of the growth rate of UK economy on German economy the whole year, right? So they are super proud of this because, as you know, the legend, the prophecy was saying after Brexit, UK economy will be completely done, and we can see that it's not even that. It's rising or growing faster than German economy. And just to refresh your memory, UK economy is the second biggest economy in Euro area. I mean, the first one is Germany, second one is United Kingdom, the third one is France, right? So this is the situation. The second biggest economy in Europe is growing faster than Germany, which is not difficult right now, consider the situation. Okay, now let's take a look to the charts quickly. Standard & Poor's, first of all. Standard & Poor's, pay attention to this chart. We are watching right now daily candles. So this is more like for a reading for swing traders. But as you can see, the response of the market after this unemployment rate and non-farm payroll was positive. The price is rising, but watch out, but be careful, because if we don't see that actually Standard & Poor's are not rising weekly over 4,500 points, let's say between 4,500 points, 4,600 points. If we see that the Standard & Poor's are not closing wildly above those levels, flexible and comfortable above those levels, right? If we don't see the prices actually breaking out those levels and close the market above those levels, I will not bet for a bullish market in this case. I will actually see that we are facing, or we got the situation of a shoulder head shoulder in this chart. If the market, if the Standard & Poor's are dropping again to 4,450 points, we're actually drawing, as you can see here, 4,400 is completing the whole figure. And if this pattern is complete, we actually got a very bearish figure, very bearish pattern on the chart, which means like it could project even the Standard & Poor's to a drop of the 4,100, even below that levels, right? So keep eyes on this chart, because it's showing clearly that this positive movement we have seen today, Friday, 1st of September, after the non-farm payrolls, the bad numbers, and therefore good news for the market, is not actually so positive. Like I say, I believe that the numbers are still super good, even if they are worse than expected. They are still super good, and it means like probably we can expect a correction on the market. You see, and this candle, this green candle that is drawing the market right now after data, is still actually doing right now. We can see how it's leaving certain prices there, that maybe it's going to turn and start to move back, and that's a really bad sign, because in that case the bearish pattern is getting complete if the market is dropping to those levels. Okay, Pay attention to the chart. Let's go to also to the second biggest index, which I mean the European one, German market, DAX, and you will see that it's totally in a lateral range. You see, this is what we got right now for Germany. It's rising. The price is rising. Take a look closely. The price is not rising. The price is still playing in a kind of lateral move, which unfortunately sooner or later can, I'm afraid, bring us a really strong correction on the price. Take a look on this. I shared this chart on my social networks like 2 or 3 weeks ago. I believe it's a clean or clear Elliott wave, totally complete. First, second, and third movement, bullish movement. We are right now, it seems to be that we are in a pullback effect, which is the V wave on the correction size, which means like if this is true, if this is the right lecture, the right reading of this pattern, probably the next step is a full correction of the whole movement, which is the wave C, which can take you even to the 50% of the movement, is moving the DAX to 40,500, 40,600 points, but definitely a correction. The main first stop will be 15,000 points, but I believe if this is the case, it's not going to stop in 15,000. It's going to actually make a correction of the whole movement down since the beginning of the year, which is, as you can see, every single bullish impulse was weaker than the previous one, and it's a clear lateral price zone right now, which prove the weaknesses of the market at this point, right? Let's take a look on the dollar, euro dollar, gold, Bitcoin, and we are done. In terms of euro dollar, we can see that the dollar is actually getting super strong. I explained this from a macroeconomic or fundamental perspective. Difference on the bond, 10-year bond between US 10 years bond and European and Japanese one. Clearly, US 10 years bond is the one more attractive for investors. It's giving to you about 4% of returns compared with 2.5 in Germany, 0.65 in Japan. It means like the flow of capital, the flow of money, the flow of cash and risk, it's going to US. That's make the dollar more attractive, and therefore the demand on the dollar is rising and the price is pushing up. I think that's the reason why we can see the dollar surprisingly getting stronger and stronger, even although when we know that European bank should keep rising interest rates, more expensive euro, and Federal Reserve are more close to make a pause on the interest rates, which means cheaper dollar. The reality is still completely different. There are many other reasons why dollar is going to get actually more strong and more expensive than the euro. And if we take a look on euro dollar, we will see that actually the relation of euro dollar, it seems to be dropping, losing even one of this kind of bullish channel that is getting breaking out by the bottom, by the support. And if this movement is keeping ongoing, and it makes sense because if European Union is a recession with a high inflation and they need to keep rising interest rates, it means the whole tools or strategies they got it right now playing are going to play against the growth of the economy, and therefore the confidence on the economy of Europe going to drop, and therefore the flow of capital going to get out from European Union and move to another areas. And in this case, the European Union is rising is growing 0.60% annually. U.S. economy is growing 2.1, 2.2% annually. Clearly, you prefer to move your money to U.S. than to Europe, and that means various relation euro-dollar. Okay, let's check also gold. Let's check oil. This is a very interesting movement. Gold is rising while dollar is strong and rising too the last few days. This is very interesting because in my eyes, one of those assets are wrong. Either the dollar gonna get colder the next days, or either the gold gonna rectify the movement. They're gonna actually correct the movement, pull it back, and move again to the area of $1,900 per ounce, or even lower than that. Because as you can see, the whole range here is showing to you that 50% of the runs, just 50% of the runs, is in the area of $1,800, $850 per ounce, which is a massive drop from the current levels, right? It's $100 cheaper. So let's see what happens. I believe it's gold the one who's going to get called. Please remember, I'm not trying to give you any kind of advice in this video, just sharing with you my view on the market. You are not paying to me to give you or to tell you what to do with your money. This is just my view and my opinion. If you are considering to invest in market, you should just consult with your financial advisor, okay? In terms of oil, look, it's rising. The price of the oil is rising, and let's be honest. Consider the levels and also consider the movement is doing. The candles sound super strong. I will say that probably we're gonna see $90, $92 on Brent oil, which is naturally one of the consequences of this kind of tensions between geopolitical tensions between those countries who produce oil, Saudi Arabia, now member of the BRICS, Russia, member of the BRICS also, against the second biggest giant in the room, which is US with fracking industry. US is still burning reserves of oil. We got also some data this week, and still it was reducing the reserves by 10 billions, I believe, 10 millions of barrels. They're doing this in a kind of effort to keep the price of oil completely cold, because they know that oil rising is an inflationary factor, and if oil is rising about certain levels, inflation in a couple of months, 2-3 months, is going to be back. Because remember, oil is the most inflationary asset in the world. So again, this is a very important factor to control the future monetary policies and what's the destiny of, especially of Europe. Bitcoin. We got this Grayscale won the battle, the legal battle against the regulator, the SEC in US. And now is making certain kind of support in the area of $26,000 per Bitcoin. I believe still this is a buy and hold asset. So whatever is the price, you just take advance and buy more if you see that it's dropping the price. I believe we probably going to face, again, another push up on the price in this case, because there are many reasons to consider that Bitcoin as an alternative for CBDCs, for world currency with this dollar. So far, the dollar is getting strong for the last couple of weeks. That means like there is no reason to hold Bitcoins for institutional hands. But still, it's a great opportunity, and I believe that's what the institutional hands are doing right now. They're accumulating in every single drop more Bitcoin, more Bitcoin, more Bitcoin, and at some point, gonna be so obvious that these ETFs on Bitcoin spot are legalized, are recognized, regulated, or however you want to call it, and then they're gonna demand constantly Bitcoins daily for the cash flow of the fund, and in that case, the price obviously naturally gonna rise up again. So again, buy and hold strategy, doesn't matter the movements is doing in short terms. It's a great asset to keep on your portfolio, in my eyes, in my opinion. That's what I'm doing, okay? That's all for this week. I hope you enjoyed this weekly report. And remember, if you are not subscribed to this channel and you want to follow me, just I invite you to follow these reports. Even I leave you my email, okay? It's Gonzalo, GONZAO Canete, CANETE @atfx.com. Contact me if you want to request any kind of report, any topic for a specific video, and I will be more than happy to make one for you, okay? Take care and good luck with the market in the coming sessions, okay? See you next week. Bye-bye.